Right now, institutional investors are trying to mathematically price two very different things at the exact same time.
Hmm.
On one hand, you have the explosive multi-trillion-dollar growth of AI data centers, and on the other, a hard Tuesday deadline for military strikes on physical power grids.
Right.
Today, we are looking at a market that is just honestly suffering from split personality disorder.
Yeah, it is the textbook definition of a bifurcated reality. I mean, you have a physical world deeply in conflict, which obviously drags everything down.
Yeah,
Right.
exactly.
And then at the same time, a digital world accelerating at a pace we have rarely seen in modern history.
Welcome to today's deep dive. If you've been watching the markets lately, you are probably feeling that exact whiplash.
Oh, for sure.
Our mission today is to help you navigate a really complex stack of sources from April 7th, 2026. We are bypassing the superficial daily recaps. We want to look at the underlying mechanics.
Yeah, getting into the gears of it all.
Right. So we are going to explore the top macro stories dominating the globe, the sector trends being totally rewritten by artificial intelligence, and of course the specific market movers,
Yeah.
from the tech giants down to the consumer brands.
The only way to make sense of those individual stock movements is to first understand the overarching pressures acting on the entire system. You can't separate the two.
Okay, let's unpack this. Because before we look at the AI boom, we really have to look at the physical storm these companies are trying to sail through right now.
Yeah, the macro storm.
Right. So our sources detail the escalating U.S. and Iran conflict, which is directly driving up oil prices. Crude is just extending its gains. But here's the part that makes my head spin as an observer.
What's that?
Well, there is a specific catalyst noted in the briefing. President Trump has reaffirmed a Tuesday deadline for escalating attacks on Iran's power plants and bridges.
Right, the Tuesday deadline.
Yeah. How do you even begin to build a financial model around a specific Tuesday deadline for a missile strike? I mean, how does Wall Street price that?
Well, the short answer is that markets are forced to become probability engines.
Okay.
When you have a hard deadline attached to military action against critical infrastructure,
Yeah.
especially in a major oil-producing region, you aren't just pricing in the physical destruction of a bridge.
Right. It's bigger than that.
Exactly. You are pricing in the immediate supply chain paralysis. You're modeling the retaliatory risks. I mean, the spike in oil prices you mentioned, that is essentially the market's real-time mechanism for buying insurance against that exact uncertainty.
Because, I mean, if a regional power grid goes offline, the oil doesn't just stay in the ground. The entire logistical network required to pump, refine, and ship it, it just freezes.
Precisely that. It halts. And that localized physical volatility, it instantly ripples out to affect the whole global economic structure.
Wow.
Which actually gives incredible context to another major piece of our puzzle today, which is Jamie Dimon's annual letter to shareholders.
Oh, yeah. The J.P. Morgan CEO.
Right. He specifically flagged three massive systemic risks this year: geopolitics, AI, and private markets.
So he's looking at that Tuesday deadline and basically saying the old ways of calculating risk just don't apply anymore.
He is, yeah. Dimon is pointing out that a geopolitical shock can rewrite global trade routes overnight. I mean, traditional financial models are based on historical continuity.
Sure, like assuming things will mostly operate the way they did yesterday.
Exactly. But a targeted strike on an energy grid is a hard discontinuity. It breaks the model.
And while all this global tension is boiling, we also have domestic economic policy machinery churning away in the background.
Oh, absolutely.
Our sources note that the nomination of Kevin Warsh to the Federal Reserve is moving ahead, despite potential opposition. But wait, if energy spikes because of the Middle East, inflation spikes too, right?
Like it does.
Doesn't that make the Fed's job nearly impossible right now?
That is the exact tightrope the Federal Reserve is walking. I mean, energy prices act as a baseline tax on the entire economy.
Right, because it touches everything.
Exactly. If crude oil stays high, the cost to transport every single good on a store shelf goes up, which fuels inflation. So whoever's sitting in that Fed seat has to figure out how to manage domestic monetary policy while being, frankly, entirely at the mercy of overseas geopolitical shocks.
That sounds terrifying.
It is, and that's why Dimon is warning about systemic fragility. Because one wrong move in either arena can easily topple the other.
So that is the Storm. It's heavy, it's physical, and it is full of friction.
Very much so.
But then, we look at the second massive force pulling on the market right now, and it's telling the exact opposite story.
The digital frontier.
Right. If you've been watching the tech sector, you've probably been wondering, are we still in the hype bubble, or are we actually building something real? And based on the corporate earnings data we are looking at today, we are firmly in the construction phase.
Yeah, we are seeing the transition from theoretical potential to hard, undeniable capital expenditure.
Let's look at Samsung Electronics. They just forecasted a record first quarter operating profit, causing their shares to jump nearly 5%. And this isn't from selling more smartphones.
No, not at all.
It is specifically driven by booming demand for AI memory chips. Now, I understand why AI needs really fast processors, but help me understand the memory side of things.
Okay.
Why is specialized memory suddenly the bottleneck driving record profits?
It comes down to something engineers call the memory wall.
The memory wall.
Yeah. If you think about large language models, the tech behind the AI you interact with, they are trained on vast, almost incomprehensible data sets. The processor is the brain doing the thinking.
Right.
But the processor can only think as fast as the data can be fed to it.
So it doesn't matter how fast the processor is if it's just sitting around waiting for the information to arrive?
That's the core of it, yeah.
Yeah.
Standard memory chips simply do not have the bandwidth to push that much data into the processor all at once.
Got it.
So AI requires specialized high-bandwidth memory. Samsung producing these specific chips and posting record operating profits, that is the tangible proof of concept.
It's real money changing hands.
Exactly. It tells us that tech giants aren't just experimenting anymore. They are buying these physical components by the millions to build structural infrastructure.
Instead of the old cliche about selling shovels in a gold rush, this is more like building the actual power grid before you can start selling the light bulbs.
That is a much better analogy. The software is the light bulb, but the infrastructure is the grid.
And you see that grid expansion happening with Broadcom, too. They just agreed to produce future versions of Google's artificial intelligence chips, and they announced an expanded deal with Anthropic.
Right, and Anthropic represents the software side, the actual AI models.
Yeah.
But like we said, software needs a physical home. So Broadcom stepping in to produce custom silicon for Google shows the maturation of the hardware layer. We are witnessing the creation of a massive, bespoke supply chain built entirely from the ground up just to support artificial intelligence.
Which naturally brings us to NVIDIA.
Of course.
Our sources identify NVIDIA as a critical player in all of this, explicitly noting that its growth trajectory and risk-reward metrics are actually improving.
Yeah.
But I have to push back here for a second.
Go for it.
NVIDIA is already one of the most valuable companies on the planet. How can the risk-reward ratio be improving when expectations are already sky high? I mean, aren't we priced for perfection at this point?
It's a fair skepticism, for sure. But the reason the market sees the risk-reward improving is because NVIDIA has essentially positioned itself as a compulsory toll booth.
A toll booth, okay.
Right. Before any enterprise company can revolutionize their business with an AI light bulb, they first have to buy the hardware to plug it in. The market is realizing that the runway for this hardware deployment is much, much longer than initially thought.
Because you can't just build a data center over a weekend.
Exactly. The physical build-out of these massive data centers takes years, not months.
Okay, that concept of the physical build-out provides the perfect bridge to our next section. Because while property developers and tech giants are laying down trillions for this AI grid, we are seeing massive ripple effects across traditional sectors.
Oh, yeah?
How we allocate risk across the economy is fundamentally changing.
Yeah, whenever a new technology demands this much physical space and capital, it inevitably collides with legacy industries.
The insurance sector is the perfect example of this collision. I mean, we think of AI as this abstract digital cloud.
Right.
But the cloud lives in massive, extremely power-hungry buildings. Our sources note that the AI data center boom is posing immense risks and rewards for insurers. And the underwriters are essentially flying blind, aren't they?
They really are. Think about it from the perspective of an actuary.
Okay.
The insurance industry relies on historical data to price risk. They have over a century of data on how often a standard commercial brick building catches fire.
Sure.
But technology has moved dramatically faster than the actuarial tables.
Right. They have absolutely zero historical data on the failure rate of a, next generation liquid cooling system keeping 50,000 custom NVIDIA chips from melting down.
Exactly. The rapid technological advancements mean the physical equipment inside that data center could be obsolete or pose entirely new thermal risks in 24 months. If a
Wow.
cooling system fails, you don't just lose a server rack, you lose hundreds of millions of dollars of custom silicon. It is an unprecedented concentration of private market risk.
Which, going back to Jamie Dimon's letter, is exactly what he was warning investors about.
Spot on.
But here's where the story gets really fascinating to me. While property insurers are tearing their hair out trying to calculate the unprecedented physical risk of an AI data center, the health insurance sector just experienced the exact opposite.
Crystal clear, predictable regulatory clarity.
Yes, the Trump administration just finalized a Medicare Advantage payment rate, increasing average payments by 2.48% in 2027. Our sources say this is expected to, quote, boost health insurers. But wait, help me understand that. In an environment where inflation is a massive concern and costs are rising everywhere, how is a 2.5% increase a boost for health insurers? Doesn't that mean they're essentially losing money in real terms?
It's a really great question, and it comes down to market expectations versus reality. In the heavily regulated healthcare market, investors were bracing for administrative cuts. The phrase better than feared is key here. The market had priced in a worst-case scenario where the administration would slash rates to curb government spending.
I see. So a 2.48% increase isn't a massive windfall, but compared to a potential cut, it's a huge relief.
Correct. And when you factor in demographic tailwinds, more people aging into Medicare, a guaranteed baseline increase provides incredible stability. So you have this brilliant contrast in how the economy manages risk right now.
The Wild West versus the administrative state.
Exactly. On one side, the Wild West of tech, where private capital forces insurers to underwrite totally unknown physical liabilities. On the other side, calculated administrative policy dictates a highly predictable flow of capital to health insurers.
It really shows how policy and technology are jointly reshaping the broader economy. And we are seeing AI reshape other legacy systems too. Like the retail industry is being impacted with startups trying to solve massive logistical problems.
Yeah, retail has always suffered from the bullwhip effect in their supply chains.
Okay, give me an example of how AI actually changes that. Because I'll be honest, supply chain optimization sounds like corporate buzzword bingo.
Fair enough.
Yeah.
Historically, a warehouse manager might look at last year's sales and order, say, winter coats in October.
Right, reactive restocking.
Exactly. But an AI model doesn't just look at last year's sales. It constantly ingests long-term weather modeling, real-time social media sentiment, and even shipping port delays. It might realize a specific cold front is hitting a specific zip code 3 weeks early, while at the exact same time, a viral TikTok video is driving demand for a certain style.
So it automatically routes the inventory to the exact right local distribution center before the customer even knows they want it.
Predictive ordering. It eliminates warehouse waste and minimizes shipping costs. And all of that predictive power relies on the massive AI data centers we just talked about insuring.
It's all connected.
It really is.
Which brings us to the reality check portion of today's deep dive. Because listening to all this, Samsung setting records, predictive retail models, regulatory relief, it is so easy to think the whole market is just going up forever.
It isn't.
Right, the market always has losers. Let's look at the daily scorecard of market movers today.
It reveals a very harsh truth about valuations right now.
The most active stocks today are exactly who you'd expect. Apple, Microsoft, and NVIDIA. Samsung is today's top gainer. But then we look at the losers, and sitting right there is Peloton. Apple is reportedly considering acquiring Peloton, but our sources note the deal is viewed as highly unattractive due to Peloton's limited addressable market and declining revenue. I mean, from a pandemic darling to an unattractive burden, what happened?
What you are seeing is the stark difference in how the market values different types of hardware. We just spent 20 minutes talking about the insatiable demand for AI hardware.
Right.
That is a structural gold rush.
Right.
But Peloton is also a hardware company. They manufacture bicycles and treadmills.
Bicycles that do not process artificial intelligence.
No, they do not. And consumer-facing hardware has a natural ceiling. That is what limited addressable market means.
Okay.
There are only so many households globally with the disposable income and, frankly, the physical floor space willing to buy a high-end stationary bike.
That makes sense.
Once you saturate that demographic, your growth stalls. If your revenue is declining in a high inflation environment, you lose your premium valuation instantly.
So even for a cash-rich giant like Apple, acquiring a declining consumer hardware brand just doesn't make strategic sense. It doesn't solve any of Apple's growth
No,
problems.
it arguably creates entirely new ones.
And speaking of Apple's growth, this might be the most sobering detail in the entire stack of sources today.
Hmm.
Warren Buffett. He has publicly expressed caution about the current market, specifically stating that Berkshire Hathaway will not buy more Apple stock in this market.
Yeah.
If you are a listener trying to manage your own portfolio right now, and you hear that Warren Buffett is hitting pause on the biggest blue chip behemoth in the world, how should you interpret that?
You interpret it as a flashing yellow light regarding market multiples. You've probably heard the term trading on a multiple.
Right.
It simply means investors are paying a premium today for a company's expected earnings in the future.
You're paying for the promise of growth.
Exactly. But Buffett is a value investor who demands a margin of safety, meaning he wants to buy a stock at a price that leaves room for error if things go wrong. When he says, in this market, he is pointing directly at the macro storm we started this conversation with.
The geopolitical shocks, the inflation.
Yes, Buffett looks at Apple, which is heavily reliant on consumer spending and global supply chains, and decides the current multiple is just too high given the external risks. He doesn't see the margin of safety. Broad market enthusiasm is basically being replaced by hyper-selective stock picking.
Which places an immense burden on software companies to prove they are adapting. Just to round out the company news, for anyone tracking the edtech space, Duolingo is slated to announce its first quarter 2026 results on May 4th.
That will be a fascinating earnings call to monitor, because standalone software companies are facing an existential threat from AI. Well, if Duolingo can prove they are fundamentally integrating AI to create hyper-personalized language tutoring, they can maintain their multiple. But if they are just adding a chatbot to an old interface, the market will punish them.
So as we pull all of these threads together, the landscape we are looking at today requires incredible nuance.
Definitely.
It's a deeply bifurcated market. On one hand, you have to balance the harsh physical realities of global conflict, military deadlines, oil supply shocks, shifting Fed policies.
Right.
And on the other hand, you have they are the engines of the next economy.
But in the exact same breath today, we discussed a Tuesday deadline for military strikes on foreign power plants. It raises an incredible paradox.
Oh, wow.
As our entire global economy becomes utterly dependent on AI infrastructure, are we vastly underestimating the fragility of the physical energy grids required to power our digital future? I mean, the cloud doesn't run on air. It runs on electricity.
That is a haunting point. We are building the most advanced, expensive digital brains in human history, but they are entirely tethered to the physical world's ability to just keep the lights on.
Exactly.
And right now, as Jamie Dimon warned us, that physical world is navigating a massive storm.
Technology is trying to outrun geography, but geography always has the final say.
Well, that is certainly something to think about the next time you ask an AI to optimize your schedule or predict a retail trend. Thank you so much for joining us on this deep dive. We hope this helped you map out the turbulence and understand the actual mechanics driving the headlines. If you enjoyed this, be sure to subscribe, and we invite you back for our next exploration of your finances. Until then, keep an eye on the horizon.